I'm Howie Lim. This is Money Hacks by the Business Times. If the past decade belonged to passive investing, are the rules of the game about to change? As market volatility shifts the playing field, can traditional index funds keep up? Today, we explore the rise of active ETFs. Is it time to unlearn the comfort of tracking the index and seek out new sources of alpha? Welcome to Money Hacks. I'm Howie Lim. And we've got expert help from Darrin from Phillip Securities and Charu Chanana from Saxo.
Thank you, Howie, for having me. We've obviously had this passive index tracking gaining a lot of momentum for the past so many years. And of course, there's reasons for it. It gives you that broad market exposure at low cost. Certainly been a very helpful way for a lot of investors to get started with investing. But last few years and going into 2026, there have been concerns around this passive investing, particularly the amount of concentration risk that you get exposed to. The concentration of tech stocks in S&P 500, for example, has been very high, about 40% last year, which has been the highest level since the mid-1960s. And I'm just talking about the top 10 stocks. That just has meant now that owning the market has exposed a lot of investors to a handful of mega cap names. And that is not something they intended to do. We've seen index methodologies really coming into question, a lot of that backward-looking nature of this indices, which tends to allocate more to what has already gone up and not necessarily be able to adjust to the more upcoming themes. That's again raised the question about whether some of the more active investors who have more targeted goals to achieve, could they really shift towards some of the more active strategies?
Thank you for the opportunity. It's a pleasure to be here. Well, for investors that usually rely on traditional index tracking, I do hope 2026 is the year that they will take a deeper dive into their basket of goods. The reason is that ETFs that track the indices are definitely extremely useful tools of investing, but the underlying index itself may not be as diversified as people think. So the passive investing aspect of investing in ETFs is slowly and maybe quietly even becoming concentrated investing. This wasn't always the case. Then AI kind of came in and supercharged it. So not to mention that although in 2025, the top 10 stocks were about 40% of the total weight, they were actually only generating about 32% of the earnings as a whole. So in today's market environment, markets are definitely more volatile. The S&P 500 is already down around maybe 5% year to date. So you do need to be aware of the growing concentration risk. So for stock pickers, the volatility might offer you a bigger return in a shorter time, which is of course fantastic for your portfolio growth. But please do remember that active decisions will make a substantially larger impact. Additionally, not every active manager is going to get it right. So being all in into the usual big names may not be the play here anymore, especially when market performance starts to broaden beyond the usual big names and the Magnificent Seven and so on. So while the volatile environment may be a better environment for selectivity, investors still need to be thoughtful about where and how they take that active risk.
And what are the real comparative advantages of active ETF strategies in the current market conditions? And why are investors choosing the active ETF strategy more, in spite of potentially higher fees? Here's Darrin from Phillip Securities again.
So today's investors are more financially literate. People tend to look at a longer horizon, as well as ask how their investments can be flexible when things change. So active ETFs are not about beating the market every day. They are more so about adapting to change, market changes to be specific. And in spite of the potentially higher fees, you are paying for that flexibility, not just performance in whichever market that you are looking into. People tend to forget that doing nothing is actually also making a decision. So you can think of passive ETFs kind of like our MRT. It's efficient. It's kind of predictable, mostly, given the current market conditions. But active ETFs are more like the availability of having a car. There's more than one route to your destination. It gives you choices on how you want to get there. And you can also react. I think that's the important thing. You can react to road conditions. If one way is too slow, you go another way. Or you can just choose to just ride it out as well. The appeal of that, and why you pay that higher cost, is because it offers that middle ground. So investors get the convenience and the flexibility of an ETF, but with a manager that's making decisions about what to own, what to avoid, when you should adjust. So that can be helpful in a market like this one, where the market leadership is always shifting around. Some valuations are uneven, and simply following an index or the index may no longer feel like the safest option. In other words, active ETFs gives investors a way to stay nimble, stay on your toes, without giving up that familiarity of owning and having an ETF. And the fee difference between a passive and an active ETF might be about 0.5% to 1% a year, roughly on average. So on a $10,000 investment portfolio, that's about $50 to $100. And investors are becoming more willing to pay slightly more just for that flexibility, especially if they believe it can help them avoid concentration risks, respond better to market changes. Well, the fee may be higher than a basic index fund, but many active ETFs are still cheaper and easier to use than a traditionally actively managed fund. More importantly, investors are seeing them increasingly more like a tool, a practical tool rather than a niche product where only a few people use it.
Still to come, what other advantages do active ETF investment strategies have, and how can investors unlearn the false comfort of index tracking? More with Darrin from Phillip Securities and Charu Chanana from Saxo in a moment.
Good conversations start with the right questions. This season, those questions are about us. The people, the policies, the forces shaping all of us. Lens on Singapore with Clarissa Montero. Back in May. Powered by the journalism of the Business Times. On YouTube and wherever you get your podcasts.
And now, back to Money Hacks from the Business Times.
Welcome back. We've been discussing a move away from passive investing, especially in the ETF sphere, and the comparative advantages active investing offers. Here's Charu Chanana from Saxo.
Absolutely. I think fees is the biggest point to consider here, but also there's a lot of regime change that's happening. So when we studied investing, what was most popularly being taught was a 60-40 portfolio. But there's a regime shift happening now in this environment where inflation continues to be persistently high. That stock-bond correlation is starting to come under the scanner. They both tend to behave the same way now. Last few weeks, we've had this geopolitical conflict going on in the Middle East, and we've seen both stocks and bonds are reacting negatively to it. So how do you get a hedge in your portfolio when those traditional ways of investing have stopped working? So I think investors are willing to pay up for that selectivity, for that adaptability, to be able to, get some targeted exposures to, say, income or some downside protection, or, there's better control over concentration to be able to respond to these regime shifts as well. And once you have an option, which is, again, within an ETF wrapper, but you get better control over these areas that you want to address, I think that's where active ETFs really become your answer.
And Darrin from Phillip Securities tackles how investors can unlearn the false comfort of index tracking so they can avoid losing out while only investing passively.
Actually, that's a great question. One of the misconceptions about investing passively is the notion that it is safe. Passive does not mean that you are fully protected or will be protected forever. So investing in indices often means that you are rewarded on what has worked on a market that has experienced consistent growth, not what will work in the future. I do not mean that passive investing equals bad, no profit, no return. But the main issue with relying too heavily on index tracking is that it creates this false sense of security. Sometimes investors hear the word passive and it means, it's balanced, it's steady, it's broadly diversified. In reality, index investing often means putting more money into companies that have already done well and have grown to their largest. So that works well when companies continue to lead. But it can leave investors with less protection when market leadership starts to shift away from those leaders. Investors may lose out on this ability to adapt. A passive fund cannot step back away from the crowded parts of the market or lean into new opportunities or respond when the outlook changes. As markets become more uneven, opportunities are more dispersed. So when we talk about a passive ETF, it will usually be in conjunction with a macroeconomic view of the economy, which investors, of course, must stay abreast of, which will then make these ETFs a viable selection for the portfolio. Each have their own advantages, active and passive. The idea is not to replace the passive ETF, but to enhance your portfolio with an active alongside the passive.
First of all is about studying the changes that are happening in the market. I mean, we have expected to see a very big IPO this year, the SpaceX IPO, $1.7 trillion in valuation. NASDAQ, that's changing its methodology around how quickly companies like this could really enter the NASDAQ 100 index. On top of that, there's a way that they're amplifying the weight that this particular company gets by using a free float multiplier. So if there is a company with a $500 billion of valuation and with a 5% float, that can potentially get a 5x multiplier. So what that means is a company that would have gotten a weight of, say, $25 billion, that is the 5% float of $500 billion, so it would have gotten a weight of $25 billion in that index. It now becomes, because of this 5x multiplier, it becomes $125 billion. So that's simply not what investors signed up for. So yes, passive investing helps you remove manager risk, get an exposure to a broad diversified index with a low cost. But one, it is not as diversified as we once thought it was. And you're paying up for something that you didn't sign up for. So the biggest misconception really is that passive means safer. We need to understand that cheap is not the same as diversified, and diversified is not the same as resilient. When you want a better control over what exposure you're getting, you want the ability to be able to express a view, then that is where passive really gets all these questions and your answers are more tilted towards that active ETF investing.
As always, we need to go in with our eyes wide open and fully aware of the risks. So what are the pitfalls to watch out for when adopting active strategies?
One thing to note, just because you go active doesn't mean you own a silver bullet. Doesn't mean you're immune to everything. So the first pitfall is usually assuming that, active is better since we said passive was, bad. Actually, it sounds attractive in theory, but especially in a more volatile year, not every active strategy delivers strong results. So investors still need to look closely at, firstly, the quality of the manager, and then the discipline of the process and whether the strategy genuinely does something different. Another common mistake people do is adopt an active strategy without being clear about the role in the portfolio, which is when you want to move from a passive to an active without being clear on what the active ETF is going to do in your portfolio, you're just moving for the sake of it. Some investors may want active exposure to reduce concentration. Some may want more income. Others may want downside protection. These are all different objectives for the portfolio, and you can't move to active just for the sake of. If this purpose is not clear from the start, it becomes easier to chase the recent performance or maybe buy into a strategy for the wrong reasons. Different active strategies use different tools to rebalance. Some may lean more into the momentum of the market now. Some may move towards a lower volatility or higher dividend yields to allocate. So on the topic of diversification, sometimes active strategies, they also do this thing where they concentrate weightage into a high conviction direction, which may actually result in a bigger drawdown in market downturn. So you'll notice a larger tracking error as the manager deviates as well. So passive investing actually is still a great starting point, but in today's market, it should not be your entire plan for your portfolio. The goal is not to be active just for the sake of it, but to be more intentional about where and how you take this risk. Take a step back. Understand what you own. Do you have concentration risk? Which direction are you leaning more into? Are you thematic now? Are you looking at the sector? Because once you understand the exposures, it becomes much easier for you to decide, okay, where do I want to stay passive? Where do I want to be more reactive and selective depending on what the world is doing? And this balance is going to matter a lot moving forward with their portfolio.
You don't want to be paying an advisor fee or an active ETF fee just to end up following an index. Does the manager really justify that fee? And I think the simplest response would be, are you able to generate the objective that you set out to achieve? Whether it was income, whether it was really being able to pivot to the more trends that are driving the macro right now. Now, we've seen trends change so quickly, right? There was a whole AI boom when any company that mentioned AI started to get a lot of attention. And then we've had this concern over the last few months where people are talking about AI disruption and be a negative impact too. Are we able to adapt to those trends faster because of using an active ETF strategy? Because we know passive indices obviously respond to these trends in a much slower way. It's absolutely important to ask that question, right? I mean, you're paying for human judgment, but are you able to generate the return that you expect to generate by paying an extra buck for it? It's not about choosing one or the other, passive or active. I think passive still deserves a lot of attention because it generates that core portfolio stability in a very low-cost manner. But certainly adding an active ETF led as a satellite can certainly give you more control over your portfolio.
Money Hacks takeaway order 263 is up. Passive investing's comfort is cracking under market volatility and concentration risk. Active ETFs offer a nimble car to bypass the, dare we say it, public transport index track, providing adaptability and selectivity for a slight fee premium. The goal isn't replacing passive, but enhancing your portfolio by intentionally deploying active strategies to navigate shifting market leadership and uneven valuations. Next week on BT Correspondence, wealth editor Genevieve Kwa interrogates Eddie Cheong from Havant about changes to integrated shield riders. You don't want to miss it. And a big thank you to Charu Chanana from Saxo.
It's been absolutely pleasure to talk to you.
And Darrin from Phillip Securities.
Thank you so much for having me here.
This has been Money Hacks by the Business Times. I'm Howie Lim.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.